on ET now, and Nifty hit a fresh record high in trade yesterday. But to understand whether the upmove is sustainable and what the fundamental market setup is looking like at the moment, we now have Mr. Sushant Bhansali, CEO at Ambit Asset Management, now joining us. Mr. Bhansali, afternoon, and thank you so much for joining us on ET now. Ashesha this side. Most of the headwinds, as far as domestic or global headwinds are concerned, are largely behind us, isn't it? Earnings in the second quarter were good. Analysts are penciling in higher growth in the second half of this year. What key triggers will help market scale fresh highs from the current level? And which sectors do you believe will beat broader markets?
Thanks for having me here. Definitely, I think 14 months of no returns on large caps, and I think small and mid caps for the last 1 year have been worse than large caps. So tough times for market consolidating, but looks like a bright future. The key triggers, I think definitely US trade deal is one which I think will boost the sentiment more than it will boost the economy though. But that's one big thing which everybody is, I think, looking forward for. But having said that, the best thing I think will be earning growth. And the last 4 or 5 quarters, the earning growth has been muted. There has been, I would say, better than expected results in Q2, but the expectations were themselves very muted. We all are hearing good things about great festive period in the last couple of months and a great wedding season. So hopefully consumption is coming back on the back of GST rate rationalization as well. But whether the earnings will come as expected in H2 or not is a big question. It reminds me of the decade between 2010 and 2020, when almost every year the same story that H1 was weak and H2 looked very strong at the middle of the year. But towards the end of the year, it was always less of short of expectations compared to what were expected at the beginning of the year. Hopefully, we'll not have such a period this time. Last 4 or 5 years have been really good from earnings perspective. And in between, I think valuations went ahead of fundamentals, and that's why a course correction a couple of times in the last 5 years. And last time the course correction consolidation was about 15 months, and this time it's already about 14 months. We'll see whether it sustains at these levels and moves ahead, or it will give it up the gains which have been there for last 1 odd months and be in the consolidation phase for some more time. From a sectoral perspective, I would say that consumer is a sector which we are all are focused on, mostly discretionary side, and automobiles being the top amongst that, because that sector has shown great revival. That has been the biggest beneficiary of the rate cut, because the absolute amount which the GST rate rationalization has provided is the largest in that sector. The prices of many models are now pre-COVID levels, while the interest rates are coming down as well, providing a great value buy for the customers. And that's why I think we have seen a great festive season. And even right now, I think the OEMs are quite motivated with the demand, and the supply chains are getting stronger every passing week. So these looks, I think, a key place from our perspective.
Right. So, Shant, I was going through a very interesting report by Ambit. It is climate as a core business risk. We were just going through that, and there have been, of course, we've had unseasonal weather that's now become the norm, and it has had its impact on, the companies, whether it is their costs and also the investor sentiment. To talk to us about what are the sectors that it has impacted, and how is that going to play a greater role given the kind of AQI that Delhi is grappling with, and now even Mumbai, and the climate is constantly under question.
Definitely, I think when we used to think about climate changes and their impact on fundamentals, economy, and markets, we always used to think that these are the things we need to worry about after 2030, 2040. But the last 2 or 3 years, especially, I think this year, the way weather has been unpredictable. We had very small summers. We might have a very harsh winter, for all you know. So from that perspective, I think the challenges have begun already, and they are for now and for later. And that's what we try to highlight in this report, which we have written. I attended a course at Harvard last year, and one of the key subjects which we discussed was on climate change. And there are, I would say, mind-boggling situations which we might come across in the next few years. The predictions are that the sea level will rise, they will have unpredictable weather across the geographies. Deserts will have more rains, and probably rain areas will strive for rain for a long period of time. So many things are possible. In the current context in the Indian economy, if you look at this year, the worst hit were sectors which had good exposure to summer products, be it ice creams, be it cold drinks, be it even air conditioners, and so on and so forth. So they have been, I think, biggest hit this year. And hopefully, if the winter is a bit colder than what we're expecting, then probably there'll be the April effects might benefit in the long season. But things have become very unpredictable, and what it does is that it impacts every sector because supply chain goes for a toss. Because if demand prediction becomes a big problem, then inventory keeping high inventory becomes a challenge for a year or two. Working capital gets blocked, and on top of it, if there are large, I would say, rainy seasons or earthquakes or something of that which happens, then it might lead to a large, I would say, imbalance on the physical assets as well. And one of the key risks which we see is lack of insurance. As we have seen in US markets, many areas now don't get insurance, be it life or be it general insurance. General insurance, as we all know, are yearly covers. And if insurance companies put their hands off and are not giving covers going forward, then there is a big risk to such companies. So that's what we have been trying to now look at and model out in valuations for companies when we look at evaluating for them for investments.
Right, very interesting report, but unfortunately we are completely out of time. We'll try again and touch base with you very soon. Thank you so much, Sir. Thank you so much for taking your time out and joining us here today. But